Guys, Netflix is a major player in the streaming world. Their stock hit a high of $700 and some per share. It says 701 right here for a 52-week high. Let's see if that's the all-time high. It looks like it pretty much is. And it had 52-week low of 162. So remember, look at this chart right here, guys. This is a plummet, an absolute plummet. If you go look at our videos in the past about Netflix, I'm sure we said the same things over and over. Value, value, value. Every investment's the present value of all future cash flow. Now, part of our job here is we want to do a 500-foot view of companies, but look into their 8 pillars, right? But in this video, backed by popular demand, is a little bit more deeper dive into Netflix. Now, is it the nitty gritty? Let's go. No, of course not, because for us to do a real deep dive into a company, it might take hours of actual research to go in there and do. But Netflix, right now, is selling at 60-70% below its all-time high. Remember, you're an investor, not a speculator. So you don't buy a company based on the price drop of the stock. You buy it based on, does the stock price currently represent a reasonable value for the business that you can make an above average return? Right, Mo?
Yeah, exactly. And this is one of those companies where you even, like, when you say, I need tissue paper, you say I need a Kleenex.
Yeah.
When I say I want to watch something on streaming, I just say, hey, let's see what's on Netflix, and I might go to Hulu.
Now, the difference between that, oh, really?
Yeah.
Oh, see, I don't do that.
I do that. I'm just like, let's see what's on Netflix.
To me, I subscribe. I canceled my cable, and I subscribe to Hulu, Netflix, Disney Plus, Paramount Plus, and a bunch of other streaming. And it costs me roughly $100 a month. Yeah. So I get all of these services for about $100 a month. But remember, guys, so one thing I wanted to look up here, list of streaming services and the number of subscribers. Look at all these streaming services that are available right now.
Wow.
There's a ton. And look when they're all started. Guys, streaming, to me, it's a very crowded market. I don't think that's necessarily bad, but you've got to remember, Netflix started as the DVD service, and they did a great job converting themselves into content creators, right?
Yeah.
Which is your least favorite streaming?
I would say Amazon Prime.
Agree, 100%. That's so amazing. Yeah. Literally, I go to Amazon Prime at the very end of my search, and usually I have an app called Real Good, R-E-E.
Great app. You need to download this, guys.
G-O-O-D, R-E-E-L-G-O-O-D. What it does is I look up a show or movie, and it tells me what streaming service it's on.
And if it's free on that, or if it's free or you got to pay for it or whatever.
Correct. And the reason I like that is it just gets so difficult to say, okay, which streaming service I need to go to? I need to check this out. It's really obnoxious. So I use that app, and there's no plug in the sense of we know nobody at Real Good. Nobody's paying us $1. It's purely, what was that?
I never heard of the app until a month ago.
Yeah.
You told me.
I love it. I told you about it because I'm like, listen, I don't want to sit there and spend my time. Now, when it comes to streaming, though, I have found myself switching between Netflix. Before it was 100% Netflix. Yeah. That's all I did. Yeah. Now Disney Plus has a lot. Paramount even Plus has a lot. Hulu Peacock. I belong to Peacock.
Peacock's good.
Hulu has a lot.
Yeah.
You know, I just finished that show on Hulu. The Patient. I finished it last night. Yeah. Did you finish it?
Yeah.
Yeah. Lisa was like, oh my God.
I didn't think it was going to turn that way.
She was like, oh my God. I didn't expect that to happen. Because at first she was like, this got a little boring. And then all of a sudden 5 minutes later, she's like, well, I spoke too soon on that one.
I think season 2 is coming.
All right. So the point is, streaming has become a very popular business, and a lot of people are getting into it. Netflix, I think Disney Plus, with all of their apps, like when you include Disney, ESPN, all the things they own, they're the largest. But Netflix by itself is the largest subscriber. It is the largest content creator. Now, it says right here, Netflix launched in 2007. It did not. The original business is back in the late 90s with its mail order catalog thing going, and they launched their streaming probably in 2007.
Did you ever watch a series with DVDs?
Like from Netflix?
Yeah.
No.
Like where they would send you one.
No.
So I did. The first series I ever watched was Rescue Me. It was about firefighters in New York and stuff. So it was like 5 seasons. I would have to send it back. They'd send it. And we just
but back then it was incredible though.
But it was awesome because like I could miss a day and then the next day I have the DVD. That's great.
Yeah, it was really good. So from this, I guess from a 500-foot view, my initial reaction to Netflix is, here's a company that 8 pillars doesn't look good. High PE, doesn't even have free cash flow. So the thing I don't like about it is you look at their free cash flow in the last 5 years. I think they now have free cash flow. Yeah, they now have free cash flow. And the free cash flow is growing-ish. But remember, when they create content, I believe that they take their content and they have to amortize it over a certain amount of time, right? So the cash flow is going to be hurt. but the earnings might look better. And guess what? That's exactly the way it is. They reported $717 million in free cash flow in the last year. What's their profit showing? $5 billion in profit. There was a big discrepancy between profit and free cash flow. That immediately makes me go, hang on a second. Because I wonder, so part of the deeper dive is I'm going to look, you have to look at their 10K and say, okay, what is their amortization process for new content? Because they're not expensing their development costs, right? It's kind of like software. With software, the difference is the margin on software is insane. And I think that the lifetime value of it is very, very high. Look at the gross profit margin for Netflix, only 40%. Okay, and that's on net income, right? But you talk about free cash flow. Look at their enterprise value to free cash flow, 212. That means their market cap plus their debt, their enterprise value is 152 billion divided by their free cash flow of 717 million. It's not high, guys. It's a very low free cash flow business as of right now because they have to put so much money in development. Look at Peacock. That's NBC. They have a library of things where they can go, hey, you know what? We're not going to sell it to Netflix. We're just going to put it on our streaming service and charge people for that. Right?
I will say, like, now, talking about going back and forth with different services, the movie theaters, they want Netflix now.
Why Netflix?
Because they're saying that they have these really good movies that are coming out, and they want them to be in theaters first, and then they can go on their platform.
Okay, so why does that benefit Netflix?
I would have to think that if Netflix does that, the movie theater services are going to have to pay up and put them out there for a couple of days, a week, 2 weeks, whatever, and then they bring them over. I mean, they can almost
I think that's
almost double dip.
But again, my question is why Netflix versus Hulu?
I don't know, but they want Netflix for some reason.
Well, let's find that out. Yeah. I mean, that's part of the deeper dive, guys. I look at it going, okay, that makes sense, but again, why Netflix then? Why not Hulu?
Maybe it's because
why not Amazon
they
Prime?
Just have a better movie studio in general. Who knows? I mean,
who has a better movie studio?
Netflix.
You mean in terms of creating content?
Creating content, yeah.
Oh, okay.
I mean, if I had to guess, the best streaming service, just based on the movies that come out and the number of people that watch the movies, I think that Netflix probably has the best of their own content. Wouldn't you think?
What do you mean?
Like, I don't, like when you see a Hulu original series come out or original show, it doesn't blow up like a Netflix series does.
But do you know who owns Hulu?
No.
Disney. That's what I was looking up.
It doesn't blow up the same way though.
But I'm looking at going like Disney's got a pretty good studio. Like I look at this saying, and the only thing that I can understand is maybe them saying, you know what? The benefit to Netflix on this is I'm a studio. I don't want to help Disney because they're my competitor. I don't want to put my stuff out on Hulu. So I'm going to go to Netflix. That's a very valid point for Netflix. And guys, I want you to see, we are literally having this discussion the way we'd have a discussion normally. Last Friday, Mo and I got on a phone call with Gary and we talked about Sleep Number. This is how we do that. We just have a conversation about it. And that's the way it should be. It shouldn't be anything like I look at it going, okay, well, if Hulu's owned by Disney, and I think there is partial ownership by NBC, I looked up.
NBC, that's why I thought NBC owned everything, but it is Disney, yeah.
So I look at that saying, okay, this is a benefit to Netflix. Let's go to our stock analyzer. Let's go to analyst estimates first. So I look at this saying, okay, EPS of $10 this year, the analyst estimate of 70% increase to $17.50. Revenue estimates, about a 50%, a little less than 50%, 40% increase over the next 5 years. Now, guys, Netflix crushed. They were expecting 1 million subscribers, and they crushed with like 2.4 million new subscribers this quarter. Remember, quarter-to-quarter results are just quarter-to-quarter results. I don't put much into them because I actually do believe that Netflix said, okay, our stock is down a ton. Let's just hedge. Let's underpromise and overdeliver and get a big pop in our stock price. That's literally what I think they did, and I think they accomplished it very well. I don't think it was anything. Go ahead.
So here, this is from IMDb, top 100 most watched TV shows of all time. Game of Thrones, HBO Max. Stranger Things, Netflix.
Yeah. Walking Dead is AMC.
13 Reasons Why, Netflix. The 100, Netflix. Orange is the New Black, Netflix. Riverdale, Netflix.
Wasn't Orange is the New Black like another... Was that created by Netflix?
It has the Netflix logo on it right here. So,
or was it Showtime? Then put on. I don't know exactly.
Yeah,
I never
right,
watched
because
it.
The Flash was not created by
Grey's
Netflix.
Anatomy is Peacock, right?
Yeah, and ABC too.
Oh, it's ABC.
There's a lot of Netflix on here, and that's where.
Listen, Netflix does a great job in making good. I do think they do a great job. I mean, look at Queen's Gambit. All these popular shows that occurred, Netflix. When I want to fight, first off, it really. I know it sounds funny. The Patient on Hulu, it drove me nuts that I had to wait week to week to week.
That's so annoying.
Yeah. I mean, look at it. Remember, this is back in the 90s. Like, guys, grow up. It's not 1999 anymore. Like, let's get our shows out here.
Hulu's notorious for that. I mean, they
What's
did
the
that
reason?
with, I don't know. They did that with the Elizabeth Holmes series. Remember that one?
Oh, that was Elizabeth Holmes series too?
That was week to week over
Oh,
there. I
that's
just
so
don't like
annoying.
the week to week stuff. The first show I ever watched week to week was Desperate Housewives.
Oh, you love that show.
That was a great show.
So, guys, if you look at Uber, now the reason I bring up Uber is when the market changed, the Uber CEO said, guys, the market wants cash flow now. We're going to focus on cash flow. Netflix was killing it. They didn't care. People were sharing passwords. They didn't want ads, etc. Now, suddenly, growth has slowed. Mm-hmm. So what's their response?
Increasing prices and no more password sharing.
And ads version.
Ads.
So the ads version is what can be $6.99?
$6.99 a month. You get 4 to 5 minutes of ads per hour of watching.
And by the way, in terms of sharing passwords, I agree with them.
Yeah. I mean, so I'm trying to remember this off the top of my head. I think they had at one point, I'm going to use round numbers, 250 million people subscribed.
100 million.
100 million were sharing passwords.
Yeah.
That's an additional 100 million people they could have had.
I have multiple logins for mine, but people don't use it in other locations. Like at my house, I have a login for me. I have a login for Lisa, my fiance. I have a login for whoever stays at my house and house sits for me. Yeah. But I don't give them the password and say, go in there and do
it yourself.
Right. That's a totally different thing. Yeah. And I'm a big believer in not stealing content. I was against Napster back in the day. I remember my friend Kurt came in town this weekend. He's like, I remember how you were always like, when Apple iTunes first came out, you were like, good, I'm going to buy music. And we were all like, you're crazy. But I believe in paying the artists for what they do. But it's funny, and I'm glad Netflix is doing this now. I would rather pay the $8 a month extra. Yeah. I can't stand Hulu because I still sometimes get ads on stuff, even though I'm paying a premium service. Yeah. That drives me nuts.
So let's say that you had a password and you lived here and you gave me your password and I used it at my house. So that's what they're cracking down on. We can't share at different locations, but now you have the option to pay an additional $2.99 a month.
I like the fact they're making it my option. Why? Because I'm going to say no.
Well, that's the thing.
Unless it's like a family member of mine.
And that's what they're doing in Latin America now. And it's not working very well. But it's smaller sample size.
What do you mean it's not working? It's
not
very
working
well?
Because now instead of you would say, no, I'm not doing that. Then this person, they're just not going to buy Netflix by themselves.
Which I don't think. I think Netflix is okay with that.
I think they're okay with it too.
By the way, they're going to get more people to buy it themselves. And at the end of the day, why should they let somebody go ahead?
And like Tim said, after a month or two, I think that person that doesn't buy it for themselves is going to go buy it for themselves.
And if they don't, they weren't going to buy it anyhow. They weren't paying for it anyhow, so it's no loss to them.
So that's in the article that I read earlier this week.
We have our software, right? We made our software so you can't log in from multiple locations. Why? Because we don't want people sharing it. That's just we spent a lot of money to create the software. We don't want everybody sharing it.
That's fair.
Okay, great. I don't blame them at all.
Something interesting that Hulu has done, they've said that you can only log on so many devices. So you can only log in on 6 devices. Netflix doesn't have that.
Well, Hulu also says, so I lived in my house in Akron.
Yeah.
I sold my house, moved in with my fiance in Sugar and Falls. When I would, they said, do you want to change your permanent location to this location? Right. I said, yes. They said, you can only do this like 3 times or something like that. I was like,
you got to call, and it is a pain in the ass, let me tell you.
I'd rather just cancel the account and then open a new account, right? I just said, yep, switching, because I moved out of Akron. I'm now living in Sugar and Falls. I was fine with that.
Netflix should do something like that. They have where you can only watch so many shows. Like if we shared an account, you watch, I watch, Lisa watch, Nicole watch, and then they're going to cut off Nicole because only 3 people can watch. Or you have to upgrade to the next tier and 6 people can watch or whatever at the same time.
Whatever it is. I have no idea. All right. So anyways, let's go back to the analysis of Netflix. So I do think they hedged and they were like, oh, we'll be fine. And I'm looking at going, but look at this right here. Profit margin versus free cash flow. This screams you need to understand what this is. Why is there such a big discrepancy? I think it's in how I know it's in how they depreciate their production costs, right? They have to, or amortize their production costs. They have to be doing that. So I want to sit here and I'm going to go into their 10K. In the very first section, it's the risk factors. Yeah. One of the things right here. For example, we estimate the content amortization pattern beginning with the month of first availability of any licensed or produced television series, documentary, or feature film based upon various factors, including historical and estimated viewing patterns. If actual viewing patterns differ from these estimates, the pattern and or period of amortization would be changed and could affect the timing and recognition of content amortization. Guys, they're basically saying, we don't know what we're going to amortize this at. Yep. If we spend $50 million on something and it's a flop, we might start by amortizing it over a 3-year period. I don't know what the number is. And then all of a sudden it's a flop. We amortize it immediately. So there's not like a set standard for like with software. It's a little bit more set standard because they know how to do it. It's like, okay, with buildings, you invest in a building, you invest in upgrades, you know exactly what the depreciation schedule should be. Yes, could there be one-offs? But I think with Netflix, I worry about a lot of income smoothing based on, oh, you know what? Because who's going to tell them, nope, this show was a flop?
Yeah.
They have the data.
Right.
So I look at that going, I'm a little weary of that in and of itself, just going, like, it's not like Disney where they have so many other revenue streams. It's not like it's a big deal for them to go, this is a flop, this is not a flop. I mean, Disney has so many different revenue streams. It's not as big of an issue. They also own a lot of sports. Like Netflix is, Amazon's just now getting into sports, right? Yeah. They just started taking a lot of people. Netflix is purely a TV show and movie, which, by the way, I still think they are the leader right now in that content creation.
Here's another piece. The increase in operating margin is primarily due to content amortization growing at a slower rate as compared to the 19% increase in revenue, and part of the delays in content due to COVID. So,
okay. Amortization of content makes up a majority of the cost of revenues.
Yep. There you go. So
they're sitting there saying like, hey, I just don't like that. To me, makes me feel icky along with net income being way different than cash flow. So let's look at this company here. You can already tell from my standpoint, I'm looking at going, all right, the stock is a very hype stock. Earnings are a big difference from free cash flow. Amortization is their largest cost of revenue. And they basically get to say, we get to decide what our amortization, because who's going to really tell them they're wrong on that one?
No one can. They're the only ones with the data.
And I look at that saying, now granted, they have the SEC to answer to, et cetera, but this is a new area. Streaming is a new area of content. It's like,
and if they're a leader, they kind of get to shape the way that the SEC makes the rules.
Well, I don't know if that's really true, but I think they can sit there and make the justification, the SEC, saying, listen, we made this decision.
And the SEC is probably maybe basing it off of them.
And guess what? Do you think the SEC is going to come out and say, you know what, guys, you amortize too aggressively, your profit should be higher? No, they're going to do the other way around. Like, to me, they're reporting higher profit than they should be. If at any point they're not going to sit there and say, you know what, we want to report lower profit. No, they don't want to do that. But the thing is, look at this. People go based on profit margin, not based on free cash flow margin. That's why we're here being investors. We want to sit there and look at these differences and go, why is this the case? So let's make some assumptions about Netflix and just do some sort of 10-year analysis on them.
See what the analysts have to say.
What do the analysts say?
So they see revenue growth of 9% in 2026, earnings per share growth 15% in 2026.
Right, but look at the growth along the way.
It's okay.
So I think Mo's trying to say like high single digits here, right, Mo?
Yep.
Now, are they going to continue growing that way for 5 more years? Because our analysis is going to be over a 10-year period.
Right. I would say no.
It's going to be hard. I think that's going to be, the content wars are happening. I think this is going to end up being like a lot of things in the past. There's going to be some sort of consolidation of content. There's so many streaming services out there, guys. Look at the streaming services. There are so many. And look at them, how many have less than 1 million subscribers. 1 to 19 million subscribers. This could be a lot of eaten up content here. And that means a lot of money outlaid. If Netflix wants to start buying some content, it's going to be outlaid.
I was going to say, I wonder if they do any acquisitions. They've made one acquisition in the past decade, and it was this year.
Go to the annual.
Okay.
Yep.
Yeah, that's it.
That's weird. Okay. All right. So I'm going to do revenue growth here, Mo. I'm going to do 3, 6, and 9%.
Okay. My thought was 4, 6, and 8.
I don't think either one of them is bad.
I don't think so either.
All right, profit margin. Let's call Netflix and ask them, hey, what's your profit? What are you guys going to report for profit margin over the next 10 years? All right, let's do, I'm going to do 10, 13, and 16.
Okay.
If they crush it. Now, free cash flow. Guys, this is my concern. Oh, man. Guys, this is me as an investor. I get very concerned about this difference here. Over long periods of time, profit margin and free cash flow should be equal. They've had 10 years. It hasn't even come close. We're 1,600 basis points away. We're 16% profit margin versus free cash flow margin difference. Even most face right now.
Yeah, I don't know what to put in. I'm 0, 3, and 6. I don't think that 0 is the most irrational thing based on what we've seen.
I'm going to do 3, 6, and 9.
Okay.
You do 0, 3, and 6.
Okay.
Now, PE. Now, 13, 15, 17.
Fair.
I'm going to do the same thing for price of free cash flow. And I'm going to do 12.5, 15, and 17.5. Guys, this is literally a big guess. Big, huge guesses here. The stock was at 700. Now it's at 270 or 260 or whatever. It's at 300 now. I hit the analyze button. Yeah. I mean, on the high side, earnings 165, free cash flow 90, low side 25 to 80. Guys, this to me just screams, I'm going to let the stock sit there. And unless it gets insanely, I have to understand that earnings and free cash flow, which I think is something Netflix has to be able to sit there and say, here's how we're determining this in much more concrete fashion. Because I just don't like this at all. And I think to myself, this is the too hard pile. And I rarely say too hard. This is the too hard pile. I'm just passing. Like if you told me, Paul, $50 a share right now, I'd say, okay. I think it's a good price. Yeah. I think so. But is my estimation of free cash flow still the right estimation? I don't know. I really don't know how the free cash flow requirements of this business long-term, because production and acquisition costs of, not acquisition costs, but production costs for a lot of content is going to be capitalized. So that's where I stand on this.
I came up with 0 and for that reason, I'm out.
Oh my God, it literally has 0. I've never seen 0 before.
I never have either. I changed this to 0.1 and it came out at 88 cents. So, but
0 margin. Of course that makes. Of course it's going to be margin, 0. Yeah. Of course it's going to be 0 then.
0 before though.
Okay, so guys,
business. I mean,
this is too hard pile. This is way too hard pile. I don't think there's any clarity on differentiation between earnings and free cash flow. I would just encourage you to don't be an investor who goes, it was 700 before, now it's 300, it's a deal. Yeah. Okay, maybe. I don't know. Go back to the dot-com era. Go back to real estate prices in 06, 07. There were crazy numbers that people said, there's no way that's going to go. It's definitely a good deal and still went way further south and never stayed there. So guys, again, this is from instead of a 500-foot view, we did about 100 or 50-foot view. You need to watch this next video on how to buy and analyze value stocks, because that's what we do on this channel. Thank you very much for your time. As the market falls, one of the most common questions I get is, what stocks should I be buying as the market falls? Great question. We're going to get into it right now by looking at our process for how we buy stocks.